this is either a big decline into a recession, or this is a correctional move. We are going to get a recession. That indicator is correct, but that is not a timing indicator. That can be 6 months from now. Tariff is going to, as you said from the beginning, exacerbate the problem. It's going to make it worse, but it's not what is going to cause the problem. And I think that is where people are misunderstanding how the economy works here. I think you're going to see a recession, yes, but it's not here yet. And the yields are telling us that, the yield spreads are telling us that. Hey, the Singapore index is telling us that. The Chinese index is telling us that. It's again, how, when, is this going to develop? But we have to, as the economic detectives we are, to differentiate between whether this is a recessionary decline, that is the first decline and we're going to see it just crashing, or it's something that will really quickly, like what we saw into Corona, where we had also the fear and greed down at 8%, seeing a very big and fast move up to the upside when liquidity starts to flow in again. But the markets will have one more hooray, and I think it's going to be a very, very powerful move higher. And the more haters that are out there, the more I think I'm right, because this is exactly the sentiment we need.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexej and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. We'll dive deep to understand the forces that drive macroeconomics, financial markets, and the emergence of a new monetary system with some money like gold, silver, and digital assets like Bitcoin. We'll also investigate how geopolitics and power games shape the world we live in, but also what can we learn from history to understand the present and prepare for the future. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Welcome back to the show, Henrik. I have to say that this is a bit of a different setting. It's been a month since we've been in South Africa. We've covered a lot of topics, and you are also very vocal about your blow off top thesis that we will discuss today, a bit of more of an update. And we have obviously a lot of things that happened in the market since then. And maybe the point of this conversation will be to dissect and look about the progression based on the last conversation, but also on obviously the elephant in the room, tariffs. We've seen the highest hike in tariffs since the 1930s, since the Smoot-Hawley Act in 1930, that actually deepened the Great Recession. And but the big difference there is that the equities were not as highly valued back then. We've seen the Russell 2000 close in a more bear market territory in the last 24 hours, a few days. We've seen one of the steepest declines of the S&P 500. It raised almost 3 trillion in barely 24 hours, and the Max 7 being more or less in the bear market territory. So my first question to you, Henrik, is how do you make of that, of those tariffs? Maybe if you want to give a bit of context as well of this infamous Liberation Day, take it away.
So first of all, everybody likes to think that when the economy rolls over and you get a recession, there's a very precise reason for why it does that. And that there is this reason that now the tariff comes out, Trump is killing trade, and hence we will have a market that is going into a recession, or the economy that goes into recession. I think that's pretty much what sums it up. But if we really are there, then we should see a lot of things that is actually following, that kind of narrative. And that is when we should start looking into what are the indicators that this is either a big decline into a recession, or this is a correctional move. Correctional meaning that this is something that comes out when the market has been going up steep, you have also rather steep declines. Tariffs, yes, they are not good for the economy, but there's more to the economy. And if you look to one thing, look at the Singapore Trade Index. The Singaporean economy is very, very much dependent on exports. And if we were in a situation now, it's actually, it's all about that. It's a global hub for supply chain. That is Singapore. If things are hitting if the global trade is rolling over, you will see it in Singapore index. So all the ones that are focusing so much on NASDAQ and S&P should ask themselves one thing. Why is it that we have seen the Singaporean index and others actually also around the world moving up from December, from December, let's just say from December, where the NASDAQ apparently to everybody has been making an all-time high and major top apparently. How can it be that we see that this index, which is the most sensitive to global trade, has been going up? And it's actually also up, I think it was up, it's a little down now, it's a couple of percent now, but it was only down like 0.4% the moment when Trump introduced all the tariffs. So there is always, when things are developing, that we always like to jump to a narrative. And we like to do because people are lazy. Most people are when it comes to analysis, and you shouldn't just listen to what the media are saying. So what I'm saying is tariffs is not a good thing for the global economy, period. But is it that the same thing as they are now causing the market to decline and the recession to set in, or is it something different? And here we can actually look to liquidity that has been declining, and there is a lag to that before we actually see that we see the effect of liquidity. When that starts to decline, you will actually see that it takes a while before it goes through to the markets, and then you will see also when it turns up again that there is a lag of 3 months or something like that. So right now everybody's jumping their gun here and saying this is because of tariffs, and of course you can see the markets reacting to it, because the market is consisting of market actors that comes in and actually reacting to the news that comes out. That's true. But it's not the same as the global economy is falling into a recession. If it was falling into a recession, we should also be seeing something like the 10-year minus the 3-month spread, yield spread, starting to rise really quickly. Actually, what we've seen over the last few weeks here, when apparently market is now rolling over, the economy has been rolling over and has been doing that for quite some time. Because we remember that NASDAQ was at the top in December and the S&P in February. We are now seeing that the yield spread is inverting again, which is completely the opposite of what we should see if we saw the 10-year minus the 3 months, if the recession was setting in. So really, where are the indicators that we have a recession at this point? And if we know that there is something called fear in the markets, which not always is, when fear comes in, all logic is evaporated, then we can look at the market and say, are we really in that moment where the global economy is at a point where it's going to tip over? Look at the jobless numbers coming out yesterday. 19,000 jobless claims. That is not a lot. That's a low number. So I just want to know why we can be in an economy that is apparently in a recession at this point. It has to be, because if it's 4 months old, the decline in the market, then the economy must be in a recession by now. And we don't see all these indicators for that. And we don't see it in the trade around the world. So my thesis to this is, are we jumping the gun here in concluding that we are seeing a major top in the market? Or is this actually a correctional in the market due to the liquidity decline we saw in October, November, and December, which is now coming into the markets? And we then see, obviously, when something like this happens with the tariffs, that people then overreact to the thing. I think it's a gross overreaction to a situation that is serious, but not to the degree that the market is making it up right now. Not today, at least, because the economy is simply not at that place. I hope that makes sense.
It does, but then I'm still wondering why the bond market still prices in a 50% probability into going into recession.
But the recession, I mean, I am the caller of, like with the guys we met in South Africa, Matthew and Francis, we are going to see a major recession. We are. The reason is that we have a general economy that has been driven on the thought that we can create global growth by stimulating the economy into and creating a downward spiral, the positive spiral of that, the trickle-down effect, as they called it, which we have not seen. We have seen an economy that has been pushing to new highs in terms of valuation levels, which are ridiculous. We have the largest bubble in the stock market. We have had that so far, and we still have a very large one, even though we see markets decline in the stock market. So we are going to see a recession, but the recession needs to be, to get here. And the recession will be triggered by the deadweight loss that we have right now in the housing market, which is becoming clearer and clearer. This is something I pointed to over the last 2 years, actually, that we could start to see this decline in what is called the NAHB housing index. Is very, very clear. You'll see that rolls over, and then you see unemployment start to spike a year and a half after. And we start to see that. But why am I not then being bearish at this point? Simply because we do not see the sequencing of things in the right manner. So we're trying to put down the puzzles, but the pieces just do not fit with a major recession setting in. So that's why we are going to get a recession. That indicator is correct, but that is not a timing indicator. That can be 6 months from now. My work shows, and I can show you this here, if you just want to see this, is that we are going to see a recession. And if we look at the my business cycles here, is that we look at what is the leading indicators for the economy here. And if you go back 75 years and you see every time you see a crossover with the what is the horizontal line here, the black line, that is when the recession signal flashes. Then it takes 2 to 3 quarters before we get the rollover into the coincident indicator, which is the real economy, which is the labor market, which is the production level, and so on. It takes 2 to 3 quarters for that. And even Corona, people said you couldn't get, even Corona it got right. So this is a very reliable indicator. And it actually has flashed, but it flashed in late quarter 4 of 24, which means that we are now still in the period where we have time before we actually get, to the recession, where we start to see the coincident indicators rolling over. So to me, we are in a setup where things are turning worse, but we have to understand also that things are not happening immediately. It's a huge super tanker. And the one thing we're starting to see now is the weakness in the labor market that I'm pointing to with my coincident indicators will be something that will be observed by the Fed. And they actually already now start to observe that. And we see that they will, of course, react to the situation. So I think there is the final phase. If I had to put the pieces rightly together, then it's not that the recession is here now. Then this is the trigger of, a very bearish setup in the market, which then when the final phase where liquidity starts to come in, and in an economy that is not rolling over yet, you're going to see the last high coming in. I know it's difficult for some people to understand and to fathom and to comprehend, but the pieces do not fit up. The sequencing of things does not fit with a major market top at this point.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth.
Okay, so there's still room for that. But on the other hand, this room is defined by what I remember from our last conversation about this famous last liquidity injection by the Fed. Yes. And if the Fed doesn't see it, the Fed, and as you also mentioned in previous interviews, but also in ours, is that the Fed has two mandates, is the economy and inflation, employment and the inflation. And on one part, you could say that it needs to make trade-offs. I would like to get your take on the inflation, because that would also define, I think, what the Fed will do in terms of policy, is that the bond market also prices in inflation back above 5% in the coming times. And on the other hand, how would that then interplay with Fed policy trying to either save the economy or get the inflation under control? How do you make up this interplay?
But actually, I mean, people can just go look. And this is again where I think people are not really looking. That was the famous line in the Big Short saying, people don't look. If you look at what happened to inflation going into the crisis in 2001, into the recession there, and you look at what happened into the financial crisis as well with inflation, and even before that as well, inflation was at much, much higher level than we are today. Into 2001, it was around 1% higher than where we are now. Into 2008, it was around 1.5% higher than we are now, where we are at 2% on the CPI. And people are saying, oh, but the Fed will not stimulate. I can tell you the Fed was cutting rates aggressively as inflation was going up in that time. So people are simply not looking. They are guessing on what the Fed will be doing. But as you said, they have two mandates. And the Fed also knows that if the economy, like what I show with my business cycle here, is rolling over, then inflation is not a problem. Inflation is a lagging indicator on the economy. That means that when the real market starts to roll over, inflation is coming down. That's what we saw in 2001 as well. Inflation was not a problem after, even though it went up into the recession. So if the Fed starts to sniff up that there is a problem with growth and with the labor market, they will cut. They will start to act. And actually, if you look at it, the last FOMC, if you look at what they did there, even though they had to lift their target on the PCE level for the next few quarters, and then they still went in and said, we're going to taper quantitative tightening. I mean, that is a shift in focus on their mandates, because they know that if the labor market starts to roll over, then we have a problem. And if you look at the latest challenger job cuts announcements, they are through the roof now. So the Fed is at, I can tell you, I think the Fed, as I said earlier, the Fed is hopelessly far behind, and that will start to dawn on them. And now, of course, everybody can, rightly or not rightly, point fingers at the tariffs and say this is the reason. Actually, like Francis and Matthew and myself, we were saying also it's going to happen no matter what, because it's something else. It's not because of what we see only with tariff. Tariff is going to, as you said from the beginning, exacerbate the problem. It's going to make it worse, but it's not what is going to cause the problem. And I think that is where people are misunderstanding how the economy works here. So I'm saying still, I think you're going to see a recession, yes, but it's not here yet. And the yields are telling us that. The yield spreads are telling us that. Hey, the Singapore index is telling us that. The Chinese index is telling us that we do not see something that is going to be a recession just at this point. It's again, when is this going to develop? And I know I said it earlier also, I think it could happen quicker, but things is taking longer. And I think it's going to take a little longer this time around, because we simply do not see the labor market rolling over in that manner that we should see. And that is why I also say the declines in the market, I see them, I feel them, obviously, but we have to, as the economic detectives we are, to differentiate between whether this is a recessionary decline, that is the first decline and we're going to see it just crashing, or it's something that will really quickly, like what we saw into Corona, where we had also the fear and greed down at 8%, seeing a very big and fast move up to the upside when liquidity start to flow in again. This time will be different because we will not be able to save the economy. At that time will be at the last time we did, but the markets will have one more hooray. And I think it's going to be a very, very powerful move higher.
If we look at the US economic index, what does it give us in terms of insight about the economy? I know that's an indicator that you follow closely as well.
Which one are you thinking about there? So there's quite a few I'm following. So just to be precise.
The Michigan one.
Right. So what you see there is obviously that things are deteriorating, and we have seen that for quite some time. And you will see that also in PMI numbers. Now we had some PMI numbers coming out yesterday also. We are seeing that deterioration. So no doubt about that. I mean, that's the thing I'm calling for. I am calling for that we're going to see a big recession setting in, and we are seeing that the indicators are starting to indicate that. So I have it just on my mind. I don't have it on my mind here precisely where we're at, but as I remember it, it actually had showed a kind of a last decline the last time I looked at it. Right, this is indicating that things are deteriorating, and this is the economic indication of the indication of that the economy is slowing down, obviously. But it's not the same as the markets will be topping out. Again, I think this is where it's so difficult to say when is it that the markets will top and when is it that we will see the economic decline. Again, I think people have to realize that the Fed will do something about the situation. The liquidity will start to flow into the system at some point. It will do that from the rest of the world as well. And again, how much of a rally will we see based on that? I think they can push the index quite far with this kind of with the developments we have now, especially in a situation where the economy is not really at the point where we see things are starting to deteriorate.
And there was also in general, if we look at this and also more tie it now back to what the Trump administration is doing, and more precisely what Scott Bessent is trying to do is there's the whole. I wouldn't even say theory because it's not something that is hidden. It's something that they have been actually talking about, saying that there will be short-term pain for long-term gain. Yeah. What the Trump administration is trying to do here, to what I understand is, and especially led by Scott Bessent, is that they want to refinance those $9 trillion of interest that are due in 2025 by lowering the 10-year U.S. Treasury notes, and thereby trying to rebalance a bit the finances of the treasuries, and in terms of, in general, the U.S. Treasury market having a more favorable conditions, and thereby calling for or trying to provoke this Trump session, quote unquote, and tanking the market on purpose. What are your takes on that? How do you see this interplay with what you just said before?
I think that sometimes some of these narratives here. I mean, obviously they want the yields lower. They wanted due to the things that you were mentioning there, the refinancing. That's no doubt about that. But also in terms of getting the economy going, and of course that right now there is a fear from the central bank side that inflation has been so much in focus, and they have been keeping the rates higher and too high for too long, as I see it way behind the curve. So there can be something to what you're mentioning here from the Trump administration, that they want to do that refinancing. Still, if you look at it, it's like this is a high stake they're playing with, because if you think that you can micromanage a multi-trillion-dollar U.S. economy, and then the same thing with the global market like that, you just swap and then all of a sudden things will be moving up again. I think that is a even naive or an arrogant kind of approach, if that's the case, because I think that when the cycle starts to get going, when the consumer stops spending, when you start to see the downturn in the economy, then you will have, it's not something you just set off again. And so if this is the case, obviously we can see that that they will be able to do that, but how the whole reset of that will come is a question to me. So I think it would be playing Russian roulette at a very high level, high stake here, if that's the case. So that's my opinion around that.
And so let's now say that the Fed starts easing and more liquidity comes to the market. If we look at the usual liquidity index, which is the M2 supply, what do you see there?
So if you look at the M2 supply, and you look at especially for the, now I look at it on a global basis, because I think it's not just about looking at the US. You actually see that the liquidity, as I started out by saying also, liquidity is something that has been declining into October, November, and December. We saw that rather strong decline in liquidity, the M2, over that period of time. And that is normally something that has a lag to the economy, to the markets, before we see that effect. That effect now seems to have been coming out in January, February, and March, and into April here as well, in the early part of April at least. But we also saw it bottomed out in December and started to move up again. So I think there is this lagging effect to it, that this lag effect will now create a new, at least supporting the market to go higher with everything else there is. And now with this extreme fear on the whole tariff side, we just need, a little piece of good news here to say, maybe there will be a trade deal. Maybe there will be something, because right now it's just fear. So the liquidity will be the part that actually already has turned that could send us there higher. And even if you look at that's one way of looking at liquidity. The other way of looking at liquidity can be the balance sheets. And this is where the central banks actually can control. M2, they cannot control directly. They can only support it by balance sheet and so on. But how the credit creation, the expansion of credit, which comes out in the M2 is really something out in the banks as well. So they can only support that. But the balance sheet now seems also to be hitting a bottom for the four biggest banks of the world. And there are some structural signs that we have seen a bottom in the balance sheet, which means that the whole tapering period, at least on an accumulated level, for these banks now seem to be over. And then we can think, will that mean that then nothing will happen out of that? Or will that mean that we will have at least an effect on that? My take is that there will be an effect on that move, and that move will then send us into the final highs before the real economy, which is something that requires much, much more when we see the housing market starts to roll over, when we see a financial crisis. And that is what, we talked about with Francis and Matthew also.
And it also, I think, ties to the what the dollar is doing at the moment, right? We've seen, I think when we were speaking back in March, we've seen like a stronger dollar. It was going upwards. It topped around the 117, I think, if we look at the Dixie. And now it's since a few weeks, it just totally crashed.
Yes.
Where do you see now the price action in the dollar for the coming months, and tying back to your thesis?
So I actually had my call for the dollar. I don't remember if I said that on the interviews down in South Africa, but my dollar target was 96, 97 in this decline here, which nobody could see when we were in December. Why will the Dixie decline? You couldn't talk sense to anybody and say, well, something will come up. And the reason, and I actually had drawn up the chart of that, which I can just share here as well. And I think that thing is that people always it's difficult to stand against the wind. So when things are going up and everybody was so bullish here on the dollar back at this level here, well, that is the moment when we also, sentiment was the strongest. You saw how it was declining as it started to decline, and the reasons, why it's going so much lower now? Well, because now we talk about the rotation out of U.S. stocks and all these things. What I'm seeing is technically it was something that I expected. We've seen these bounce here in the dollar technically going on for some time. We saw it over here. Then we had a decline here, which was something like what we saw there. We also had it here, and here. Oh, sorry, that was a little too low. But anyway, you got the picture here, and there. And now you have
I don't see the screen, unfortunately.
Oh, you don't see the screen, man. Okay, sorry about that. I should have showed the whole thing there. So I apologize. But let me do that one more time. Now you see my screen?
Yes.
Okay. So what I drew up, as I said, you have structures setting up in these things. So you see that we had a strong rally. You had a decline like this, ABC, strong rally, ABC, decline. You had a rally up here and ABC. So actually, this was based on that kind of setup that I could see. Well, I think we're going to see a similar kind of situation here, where we first will see everybody rushing into the dollar. Then the dollar will be cooling quite a lot down to 96, 97. And that will help risk assets. And then you can say, oh, but that's not happening right now. Correct. That is not happening at this point here. And you can say that then the whole thesis may be off. I think there can be a lagging effect on it. And we'll still see that when yields are starting to roll over, as we see also now slowly, we see the 10-year, we see the 2-year. And with the liquidity coming in, well, that is something that could help in the last phase as well. So I still have 96, 97. And my question to everybody who thinks that we have a major stock market top would also be, how can it be that we see the Dixie is declining and has been declining into a major recession, if that's what we have now? Because all debt in the world is in dollars. So if things were starting to unravel, you will actually see that people will be needing US dollars, and then yet it's declining. Another piece that doesn't fit into the puzzle. So again, if I'm an economic detective and I have to say, what are all these pieces telling me? Are they telling me that we are at a major top? Or are they telling me we have a correction that may be surpassed to the top, which is what I think it will be?
If we then look at one of the other indicators that you mentioned, like in the housing market, and it's more specifically the builders, how does this fit into this picture?
No, so the housing market is really the deadweight loss. Then that is what is going to create this. I've called it the worst recession since the 1930s, and I stick to that because what we have is that we have a market bubble that is bigger than it's ever been. It's twice the size it was in 2007 in market GDP to capita wise. And you see that if you look at the housing market is as I said, the deadweight loss, and it takes a while for the housing market really to start getting when it gets hit. It takes a while for it to go through to the real economy. There's really two sides to the real economy. That is the housing market and the labor market. And we know if our houses loses some value, we don't feel so good, and we may not take out that extra loan. And if we lose our jobs, then we really get start to see something that is feel bad, right? So here you see the NAHB housing market index, which is a sentiment among builders and so on. We see for the single family homes, and you see how that started to decline here into this phase. And you saw that then some time progressed, and we then saw a unemployment rate moving up. This is actually up because it's an inverted rate, inverted scale. Here into the into the financial crisis, you saw it come down strongly. Some time elapsed, and we saw then the rollover. Now, we have actually seen this rollover from this time on, and it's been progressing for quite some time. And then people saying, yeah, but you don't see that at the same time. No, we don't see that rise in the unemployment rate. No, not yet, as I see it. Not yet. And this is the thing. I think we are going to see this rollover here. And actually, we see that this is now breaking even lower. So this is not a good thing. This is telling us that the housing market in the US is not good. This is multifamily homes. The delinquency rates, serious delinquency rates on multifamily homes, this is the financial crisis. This is where we are at now. So if everywhere we look in the housing market, if you look at the, let me see if I can find this here also with the, hang on for 1 second, maybe it's not even here. The reason for all of this is, of course, the affordability of things. So people simply cannot afford sitting in their homes and refinancing a new loan, but more, even less to move into a new house. So this is really what is the problem here. That's why the housing market, the existing home sales, is at a standstill. Even though we have low unemployment, we are at a standstill in terms of the existing home sales. That is also why when Bernanke came out and said, no, not Bernanke, obviously, Powell said we had such a great, strong economy. I'm like looking at where do you see that? You don't see any activities in the housing market. So this is really the thing that is going on right now. That is that we have a rollover of the housing market. And if you remember in the financial crisis, this started out already in 2005, 2006. Then some time progressed because it needs to go through the real economy. It takes us a while, but then eventually it will go through. And when it does, that is when you have the big crisis. The big crises are the ones where you have the housing market rolling over. That's a balance sheet kind of recession. And this is what we're going to see this time again. That's why you're also going to get a financial crisis. And I think this is what people do not realize. So really, we are heading into something bad. The housing market is the deadweight loss that will create problems in the banks. And that is what's going to also create the credit crunch that I think we're going to see. But all of these things would require that we are into a recession. And the recession would require that we see some of the indicators that I talked about, like the yield spread not spiking up, the short-term yields not declining as fast as they should, and all these things. So recession is coming. I just think there is a liquidity boost to it first from the Fed side.
Okay, and this is, I think, it might also be, that's why it's also so contrarian, or maybe it's difficult in terms of, I would say, financial cognitive dissonance to bring in those two things together. And it's also maybe why your thesis steers so much also reactions online. We see on the comment section, like people really going wild. You have to deal with this on a daily basis, and maybe like for the haters out there, maybe it would be good to then lay out, where do you see this liquidity then being injected, in which kind of assets? How will this play out in terms of movement? Some might even claim that, well, and that's what Francis actually mentioned then last time in our conversation, is that if the people, if the market participants see that there's like this last kind of liquidity injection coming in, will it even go into risk on assets? Because the market knows, it smells that a recession is in sight, and thereby will rotate into more defensive assets.
Yeah, I think that is where, again, we have to understand what is always the sentiment we see at the top of a market, real market top. At the real market top, we always have the Fed has got our backs. That is the word we always say, oh, no, Henrik, that's what I experienced when we get to the other side. We'll say, well, Henrik, you don't get this right. This time the Fed really went in, and now they really got our back. So they got it all covered. And this is where sentiment can be such a tricky thing. When you are at the one end, you cannot see how it can be the other end of it. Like with the dollar we just talked about. When I was there, I started to say it's going to decline. No, Henrik, why would it decline? Trump coming in, tariffs is going to make it rise. What do we see? We see the opposite. So when people are saying, you cannot see it, people will be wise enough. First of all, there's nothing, as wise investors. I mean, there are fearful investors or there are greedy investors, and that's what there is. I mean, the wise investors, I think there are maybe a few in this world that really understands that, it's not what the market thinks. And the more haters that are out there, the more I think I'm right, because this is exactly the sentiment we need. This is exactly the sentiment we need. We need, like in 2022, also when I was talking to, not to you at that time, Sergey, but Alexej, sorry. At that time, we were seeing the same thing. People were saying to me, Henrik, you will be wrong because you are, obviously, inflation has now killed everything and you'll not see. And again, at that time, I was actually more, let's say, secure about the position because we did not see that crossover. This time around, it has to be inflation driven. It was not driven by the real economy. Back there, it was the real economy. Now, not inflation driven. It was liquidity driven. This time, it's liquidity driven. And I think this time around, we will have to see. People cannot envision what the Fed can do, but we have seen it before. I mean, don't tell me people can't remember what happened in Corona. Also, what did the Fed do? Flush the market, right? They will come in. They will do something at some point. And they will not just, because if there's a moment it starts to hit the real economy, remember their mandates, which is the labor market, and we have the labor numbers coming out here soon, they will change stance, and we are already seeing that. So how they will do it, I'm not wise enough to see that. They will do something which will be seen as liquidity injection to the market. We'll see the M2, the balance sheet, start to moving up again, and that will support the market for some time. And the bears will become raging bulls.
If we then look at more specific predictions or price action in now, let's start with the equities, because it will be like where it all plays a big role. How do you see that then draw up in terms of a chart in price action for the S&P 500?
So we have to see now where we end with this correctional move. I have said still that I think we are going to see quite a significant move higher. It was based on the levels that I had, when we had the correction hasn't gone as deep as it has now. I still think that we're going to go well above 6,000. I think we're going to go 6,500 will be a target. I say 6,700 also at some point. So we have to see. We need this decline now. We need this where nobody thinks can end. That this is just it. But I actually think when we see that kind of bottoming that I think can be coming in sooner rather than later. Let's see where that ends out and what that then can trigger. That can trigger in terms of a market bounce and also rally into new high. So I think we're going to go a lot higher here. This is not really the big thing just yet.
And for Bitcoin, which is, let's say, a more on the riskier risk on spectrum of things, where are your projections there?
I still say that might been my target a long time. Around 130,000 is where I see we are heading into. And actually, if you say, just as you said, it should be the more riskier thing. It has had a 30% decline, which we have seen many times over the years. Even in bull markets, we see 25% happen over 2 weeks, no problems, and it goes higher. Now we have had this going on for 4 months, and people are just devastated and think, okay, now things can't go any higher. So 130,000 is what I see for the market top when we see this reversal in it. And I think also there we're getting closer. I start to see some of the same signs and patterns that we saw in October of 24. At that point, the trigger was Trump coming into office into November, but also the whole period up to that. And this time around, I think it'll be something with liquidity. I think liquidity will be, that the Fed will not let this fall, and they will do something about it. So I think the Bitcoin will go through that. If you look at altcoins, which has been crushed and people are just devastated, we are now. I don't. Now we've been talking for half an hour here, but and we see that China's just retaliated. So on the tariffs, but what we see is that the altcoins index is up 60% since August 5th last year. 60%. It's up 160% since the bottom in January of 23. And people are telling me that we are crashing. I can tell you, if we were 4 months into a crash and the recession was here, altcoins index would not be where they are now. And the whole, memes and things would be, evaporated. So this is what people, and Bitcoin wouldn't be above 80,000. So I think people are misunderstanding that, the whole setup here. And that's also why it seems to be fear in equities at this point here, because of the tariffs, because certain companies are going to get hit. But really, is that where the markets will top out? I don't think so. So 130,000-ish on Bitcoin. And I think you're going to see new all-time highs on the altcoins index also. Liquidity is something the crypto really like when that starts to flow in.
And if we look at, let's say, at more technical levels, for example, the RSI and if let's say, what's your benchmark? Is it like hitting above 70? Are we gonna hit like a multi-standard deviation high on the Bollinger Band, or like what are the things that you look at then on the key indicators for that part?
Well, very, very technical question. So there is on Bitcoin a level, if people go back and see the highs that we have had all the way back to 2013 over 2018 and 2021, you'll see that there is a level kind of a declining tops on the RSI. And if you look at that, then I think we can get up around that level. So if you're very specific there, you want me to be, well, then I think you can see the RSI on Bitcoin reaching in the 80s, 90s, almost 90, right? On the monthly chart, so to speak. This is a monthly chart. Let me just see it here. And that means that there should be some significant upside, a very strong rally to the upside. How do we get that from here? Only by the things that I'm saying, that there will be a change in tune because of liquidity, and then things will be a run up like what we saw in October, November. Not as far, maybe not as fast also, but something similar. And then momentum will be, rising to those kind of levels. I don't do the Bollinger Band so much, but maybe I should. But I think, again, negativity, pessimism in the market is something that is good if you understand that, if you at least believe that, that's what I believe, that the market has not really the economy has not capitulated yet, and it's really about market sentiment at this point.
Now, if we took up, because we haven't talked about oil at all, and oil might be also one of the most important indicators if you want to look at the economy. Right. It's been down 8%. Where do you see the trends there?
So actually, I've had a chart for a long time and I can just encourage people to go check a look on that on Twitter, and I'll just bring it up here, and said that is actually the very reason why I also think that we're going to have a deflationary bust first. And people were saying, just a few months ago, people would not understand that and say that sounds strange. Why would we see a deflationary bust? And if you look at it, well, it seems like this pattern is actually playing out. So when I look at things, I look at it in a long time frame, and I look at these patterns. And what I look at when we see this from the top here in 2008, this is actually a very, very big pattern playing out down to the bottom we saw in March here in 2020. Then we have seen the rally up to the highs, and we had the panic inflation scare here into 2022. And I said, I think it's going to come down because we see also oil, and really we're not in a situation where oil will just keep going up. Remember, they talked about oil of $200 there, right? Then we saw this decline here. We have now seen it go sideways for some time. And on Twitter, I've been pointing out, or X, I've been pointing this pattern out. And again, people need to do this pattern correctly, not wrongly. So we come down for something high. We bounce into an A, B, C, D, E, where it actually sticks its head above, not above the C wave. And then you crosses below. This is what I've said also. I think you're going to see this actually continuing And this is actually for a certain amount of time, this will be positive for the economy because oil down is good. And I think there may even be a situation where the Trump administration have been talking to OPEC about, because it seems like they are now increasing demand at a time where we see that increasing supply, obviously, when at the time where we see demand is dropping because of the slowdown. That is creating a positive environment, supporting environment, because that is good for the economy. Cheaper oil is good. And I think that will eventually turn into outright deflation, but nothing happens in a straight line. And that's why I'm saying also there will be bounces somewhat like this, and then we'll see the deflationary development into the recession. But now it is on the short time frame, it is actually it's a positive thing.
You just mentioned it because now I also put it up on my own screen. I just saw as well that China hits back the US with tariffs with 34% duties on all US goods. It's quite a debacle. And it seems a bit absurd also when we look at the way the Trump administration chose those tariffs was based on a very bizarre calculation that if you want you can lay out.
I'm actually not. I didn't see that. I was told, like what you also seem to have been told, that there was a funny explanation on how they put these tariffs. I did see though that there were a couple of islands only inhabited by penguins that also got tariffs really hard, and I think that's a little sad for those poor penguins. But again, the way they walk, I mean, it seems like they own the place, right? So let's tariff the shit out of them. But sorry, my friends. But again. I also saw that Vietnam had a heavy tariff on it, and I think actually the relationship between what Vietnam is actually importing and exporting is going to hurt the Americans much, much more because the import was so big. So it's going to hit the Americans, and not Vietnam will hardly notice that. So, I mean, I think there are these how they have been calculated. Probably there's some wise guys sitting there doing that. And also they have a good understanding of why this is a good thing. I don't think it is in the long time frame. I think and you can see the markets may, at least sentiment-wise, agree with me. But I don't know how they were calculated. But what I do think that will happen is that nobody wants this to continue. And I think that there will be, over the next few days here, which can be also the reason why we see a bottom, that there will be some folding in and saying, yeah, but let's find a deal. You saw Mexico and Canada. It didn't take long, right? Boom, small deal going on. I think that can be the same thing here. So the Trump administration can walk away and say, we made a good deal, and now they're not, the bad guys any longer. And then people say, oh, wow, where are we now? And liquidity is coming in. And are we really that bad? And let's see the unemployment number coming out here in an hour, what that's like. I can see even a good number and a bad number becoming positive for the markets, actually.
As you can see, a new background here. We had a bit of an internet connection problem, so Henrik was patient enough to wait for me to continue this conversation. And the question I wanted to ask was, if we look at the current onset of this trade war unfolding, where are these scenarios? What if this actually lasts for longer than we can expect? What are your scenarios in there? Because you've just said you think it's temporary, but what if it isn't?
Yeah, well, if it's not, then we will all suffer. And I think, again, I can also envision that this is, I'm not sure we're going to get the 100% resolution to it, everything, and that will be, I think there can be some easing of tensions on this. But also, if we go into a recession, which I think then I could also envision that there will be some, tariffs still on both sides maybe, and keeping it up because, it's... you want to protect your own economy, you want to protect your own businesses, and it's more difficult for leaders to open up when the economy is not doing well. And then so I could feel that could be happening. So it's not necessarily that we're going to see the whole resolution to this whole situation, and that can also be why when we get further down the road that we will have even a larger recession than we may even have had. And you mentioned the situation before and in the Depression also, that there were 20,000 goods back then being tariffed. And I think that can again be the situation, that we could definitely see tariffs coming up again.
Now, back to your thesis. When are the moments when you think or you have indicators that you're actually wrong, which we must entertain?
Sure, absolutely. I think obviously the stock market needs to bounce at some point. We need to see that otherwise I will be wrong, right? But then the thing is, we need simply to start see some of the things that will tell us that we are getting close to a recession. I mean, there will be a heck of a lot of indices out there in the world that needs to also catch up with the S&P in terms of the decline. We need to see the Singapore index starting to decline rapidly. I mean, if it should be, it's so far behind the curve, talking about being behind the curve, that if it until the other day, there were no problems in the Singapore index, and all of a sudden, the world is collapsing, which the Singapore index, by the way, did not catch. Anybody who's investing there did not see that until one day ago. Well, so let's see. And the yields need to plummet. I think they have to plummet soon, because if I'm wrong, that means that the recession is here very soon. And if that means that, then 2-year yields should be declining very, very fast. And I'm meaning plummeting, like 10% down on the day or something like that. Some of these things should start to develop. But again, you don't see the 1-month yield. It's still up, hanging up there high. You don't see the initial the yield spread spiking at this point. You see, as I said, we actually saw it inverting again. So at this point here, the only thing pointing to that I'm wrong is the narrative and the markets at this point. And you say that's hard enough for the equity markets. But if you look at everything else around it for now, it doesn't seem like I'm wrong. So let's see what happens in this. But obviously, if some of these things start to begin to happen, and also the dollar bottoms out and start to move up, because again, find it hard to see how the dollars could keep declining into a recession.
And now for the commodity side, we've seen energy doing pretty well in the last months in recent times. Mm-hmm. And in general, like the weaker dollar and the halving of what Tavi Costa, who I interviewed recently, he was expecting that the 2-year yield would halve from 4 to 2%, and that this would actually propel and be the basis of a commodity supercycle. Mm-hmm. What's your take on that?
First of all, I think yields will decline fast. I mean, there's no doubt about that. That's going to happen because we have a recession that sets in. But in a recession, you will also be seeing, as I said, when that happens, the real cycles, the real sequence of things. You should see the dollar moving up, and that's not something commodity likes. And the commodities will also not like that you see that there is by the economic downturn. That's not something that's good for commodities. So I'm with the perspective. I understand the perspective that we're going to see a super cycle in commodities. I just think we need to get further ahead. We need to get down to the point where the Fed, in the recession, when we are there, the moment when the Fed comes in with the guns blazing, they don't do that after 10 or 15% decline. They don't do that after 20% even decline. They will do that when we are down 40%, 50%. Then they will come in with a lot more than what we see right now. So for now, this is still, just on the surface, and they will also be observing. Of course, they need to see negative numbers on job creation and the likes, and see other things that have started to roll over. Remember, it's not so long ago that they were really hawkish on really saying the economy is so fine, right? So we need to see that the Fed is coming in and starting to do some of these things here. And the moment they come in for real, the moment where we have, let's say, if you go back in 2007 and 8, you saw that the Fed was starting to stimulate already there in early 2000. I can't remember. I think they did 2007 in September. They did a 50 basis point cut first. And I think that then until September 2008, so 1 year later, was the moment when they came in with the guns blazing and they did QE. I think this time around, again, to build things up again, to pump some value into stuff, they will have to do quantitative easing or something similar, which is going to be, dwarfing anything we have seen this time around until now, even with Corona. So that will be the moment that when we are in recession and the deflation stares the Fed in the eyes, then you will see that the Fed comes in, and that will be the moment I think this super commodity cycle will trigger. Not at this point here. I'm not seeing at this point, and you see oil now is rolling over, telling us that it's a demand-driven world for oil and commodities, and if that rolls over, it's probably not a good sign for what's to come.
And if we look at then gold, which has been seeing a massive surge since the beginning of the year, but also, frankly, just the last 2 years, actually on point of outperforming the S&P 500 for the last decade. So where are your targets there? You've mentioned last time that gold should have had a correction already at 228 to 2,800, which did not happen.
3,200, I think. Yeah, around that levels, because there's a few extensions there around that, and we have the 3,200 now. I think we not really hit the top of target there. But if you look at what silver is doing now, it seems like it didn't make a new high compared to what you had in October 24, and I think people should pay attention to that. You see there's a massive negative diversion on silver, diversion on silver, which means that even if it makes a new high, it doesn't make a new high on a weekly level on the RSI, which means there's a weakness in it. Why would we see a weakness in silver and gold continues to go higher? So I think gold is the outlier here. I think gold is the one that has been running way too high. 3,200 is a fantastic level, and I hope people make a lot of money on that. But I just want to caution that if we get a deflationary bust at some point, that will not be good. But for as long as the dollar can decline 96, 97, and even also into the boosting phase from the Fed, you can see the gold can do well. So I could see it higher. I can also see it. I have to say that. But I would just caution and say, look at silver, look at the gold miners. They are not like exploding to new highs. So I think it's been talked up a lot, gold. And I will, as I've said also in South Africa, I hope I'll be investing at the right time. But I'm not sure this is just yet. Also because rolling over of the housing market, financial crisis and the likes, will not be a time for people to seek what is the best investment. It will be a time to find out how can I get cash. And there may be a big difference between the price in physical gold and also in paper gold. And that can be something that people can speculate in. And that can be, I don't know what that difference can become, but there will probably be a difference there between physical and paper gold.
So now to conclude, if we look at really tangible actions, maybe in terms of portfolio management, in terms of assets that we want to have now for that upcoming phase, that would be the preparation for what you think is going to be then a blow off top. How are you then positioning yourself?
Well, I still hold some assets that probably have been hit a lot now here over the last few. That has been hit a lot over the last few weeks. I am picking up some more on the crypto side when I start to see the liquidity cycle is turning up again. I'm not sure I'm going to play it so much on the equity side. I have some bonds as well also, but then we'll potentially also buy more into that. If you look at the ratio, the risk on, risk off ratio for bonds versus or stocks versus bonds, then you actually see that that's now turning in the favor of a more conservative portfolio, and I'm following that. So, but I think again the liquidity cycle, that when we see that moving in, will be something that will cause a massive move in assets, in risk assets. So I think so for now it's about being a little daring and maybe picking up some of these things that are being sold off quite aggressively at this point, because I think there will be this final phase. But going into the big thing, I think it'll be good to have some bonds until the moment we see the Fed coming in again. Because when the Fed comes in, like in 2008, that kind of thing in September, I think they can trigger something quite differently, which will be a stagflationary development at some point. And there, you don't want to hold bonds.
So in terms of bonds, I mean, you just mentioned it. Would, let's say, a rotation into TLTs be something, or which bonds specifically?
Oh yeah, I mean, we can just look at what happening right now with oil, right? So we see that it's actually coming down quite strongly, and that is the whole talk about inflation and why the Fed should be keeping rates high, and also why yields are high. It's because there's been this talk in town about inflation. Inflation is not a problem at this point. I mean, yes, price has been moving higher, levels has become higher, but it's not the same as what is the price development, and especially not when we look down the road. So when inflation is rolling over like what I think expected to do with the business cycles, well, that is the good time to hold bonds. Again, for as long as we maintain that we are in a deflationary environment. The moment we step into what I think could be a stagflation environment, that will be when the Fed comes a little further down the road. We have seen more decline, and we are in a recession, which will be in a year from now or something like that. Then I think things can be much worse on the bond side. Then I will not be, I'll probably be selling, but they can take they can go through quite a rally until then, with the yields coming down very strongly.
All right, Henrik, I think we've touched upon a lot of important stuff. lot of things to unpack. And it's been also a great review about the past few weeks. Is there anything else that you think is important to address before we round off this conversation?
Well, I think now you are from a gold company, and I think that even though you can be bearish gold in a setup where you have gold as gold versus the dollar, well, then if you look at the setup, gold versus the risk assets, so gold versus SPX, for instance, then you will actually see that there is now a very interesting decline. So do the ratio between gold, SPX and gold. You will actually see that there is now a decline in that, which means that the gold is now starting to outperform, as you also mentioned, and to a very large degree. And I can actually see that it seems like we were at the same levels that we had into the Nixon time when he abandoned the gold standard. And I think we will see the SPX in terms of gold terms getting, seeing that ratio starting to decline. And that means gold will be a good place over the next many years, I think. So that is to stay, aware of that. But it's more like right now, if you also put in the dollar in the equation, well, then there will be a time where probably both of them can feel the heat.
Great. Great way to round this off. Henrik, as always, a pleasure to be speaking with you, even though it's remote this time. Maybe next time it's in Amsterdam or Copenhagen, who knows. Thanks a lot for your time. And you have obviously many things that you share on X. Is there any other links or resources that you want to point towards the viewers?
Actually, it's on X. That's where the easiest way to find me. So at Henrik Zeberg on X, and just contact me if you have any great. And by all means, people can be negative and all that. But if you have any great perspectives, any analysis that I should see, then please reach out. And I'll be happy also to interact with you.
Yeah, and I think to all those people nagging, maybe it's also good to be constructive and giving actual constructive criticism, if there's any, of those things, because I think X is also a great platform for the fact that anyone can say things, but to the basis that it actually adds to the conversation and it's not just defamatory or just negative, plain outright, just calling names and so on.
I have no, that's on people and it's not. And so, but you're right. But too many people just coming out with bad energy. Try come out with use your power on analysis instead.
Exactly. Thanks a lot, Henrik.
Thank you.
I wish you a great day, and I hope to speak to you soon again.